Hello aspirants and welcome again to Legacy IAS Academy. In this lecture, we'll be continuing with our current affairs compilation series specifically designed for the upcoming prelims 2025. This has already started from the month of February and all the subjects have been covered month-wise. So I hope you have gone through all of that. In this lecture, we will be seeing the month of April 2025 with respect to current affairs from Indian economy. So let's see what all is in store for us. The very first thing that we'll see is the NITI NCAER States Economic Forum portal. So what is this portal all about? What does it include? So on and so forth. Then we'll see the 90 years of monetary policy. So yes, it has been 90 years for the monetary policy. So we'll see what all are the components of monetary policy. Some amount of static portion with respect to monetary policy becomes important. So even the static questions that are asked are generally from the topics which are in news. So that becomes important as well. Then we'll see the DMISP, that is domestically manufactured iron and steel policy. What is this policy? What are the key features and highlights of this policy? Why is it even brought in, etc.? Then we look at the RBI's remittances survey. There is a significant shift with respect to the countries from whom India gets the highest amount of remittances, as a result of which this becomes quite an important fact for prelims. Then we'll see the National Bank for Financing Infrastructure and Development. It has signed a memorandum of understanding with the New Development Bank. So what is this? What is New Development Bank? So on and so forth is what we are going to discuss. Then the credit flows in MSMEs. So the credit flow has always been an issue with respect to MSMEs. So we will see how much is the gap and what are the schemes, etc., that are in the MSME sector to cover this gap. Then the non-tariff barriers, we might be aware already about the tariff barriers. We'll see what they are and how the non-tariff barriers are different from the tariff barriers and why is this in news. Then finally, we'll see the World Bank's poverty and equity brief with respect to India. What is it saying? Is India doing well or not with respect to poverty elevation? We'll see all that in this particular lecture. So let's get started with the very first news of NITI NCAER States Economic Forum portal. So the finance minister has launched the NITI NCAER States Economic Forum portal. Now, of course, in April, because we are dealing with the April current affairs, so this particular portal has been launched. Now, what does this portal offer? Basically, this portal is going to offer 30-year of consolidated data of social, economic and fiscal parameters. So remember, social, economic and fiscal parameters of all the Indian states. So all the Indian states, right? This is what it is going to offer. Now, basically, it is nothing but, see, each state have the data. They have simply compiled it and made it available centrally at one place. Of course, this data is going to help the policy makers in formulating policy, right? So that is the importance of it. So what is it? It is basically a digital platform. You can just simply log into it and see the data. So it's a digital platform is what we are talking about, which offers comprehensive statewide data. Wide data it offers with respect to each state. The year it offers is around 30 years from 1991 to 2022-23. As we proceed, more and more data will be populated. The important point to remember is it starts from 1990-91, wherein India started with its economic reforms, right? It provides evidence-based policy. It will provide support to what? Evidence-based policy making and research. So what kind of policy should we come up with, so on and so forth. When you have a data, historic data, you can see the trend, you can understand what worked, what did not work, etc., etc. With respect to that, you can formulate the policy of the future and research as to what can be the better way forward. Now, who has developed it? NITI Aayog has developed it in partnership with NCAER, that is National Council of Applied Economics Research. Very important facts for your prelims exam. Now, it is launched by the Ministry of Finance. It is going to serve as the centralized hub of the data for state level. Now, it also would aid researchers, policy makers. These are the benefits which are very logical. and it will encourage data-driven policy discussions and fiscal transparency, because now the data state-wise is all going to be present at one place. It gives you ease of access and creates transparency among the state as well. Now, there are 4 key components of the portal. The very first is the state reports. It's going to cover all the 20 states, and of course, it will talk about few important things. One is demography. Demography means the structure of the population, working population, non-working population, etc. Then you have economic structure, socio-economic and fiscal indicators. Then you have the data repository. Repository means an accumulation of data, access to raw and categorized data under 5 verticals. Important to remember this 5 verticals. They can simply give you the verticals and ask which of the following are the verticals in the NCAER portal developed by NITI Aayog. Right, so these verticals are demography, economic structure, fiscal, health and education. So you can see basically they deal with these socio-economic factors, means society related and economic related factors are there. That's how you remember generically, and then go into the details of remember specifically about the demography, about the economic structure, fiscal, health and education. Now, the third key point is state fiscal and economic dashboard. So what is a dashboard? Basically, dashboard compiles all the data and gives you a summary. That is what a dashboard is all about. So it will visualize key economic trends and provide easy to access graphs, summaries, downloads and databases. Why this is important? Because each state will have so much of data, right, of various things, and they would have represented it in different manner, right, different charts, different pie charts, different tables, etc. So this compiles, it reproduces in a summary like dashboard, wherein it will convert the data into simple or linear kind of method. Some state might have given it in the form of pie charts, some might have given in the form of histograms, some might given in the form of a line diagram, some might have given in the form of a table. So it is going to convert all that and present a dashboard which will consist of the summary and the various economic trends as well as graphs, etc. I hope that's clear. Then you have research and commentary. In-depth analysis of those data will be given. Then you have expert views, that means the commentary on it, experts' views on the finances and the fiscal policy. This is going to be sort of an advisory, a guiding light for the policymakers of each individual states and even the central government. So this is how it is quite important. Let's move ahead to the next news, that is the 90 years of monetary policy. So what has happened? RBI has completed 90 years since it announced its first monetary policy in 1935. Important fact, it's announced in 1935. It has been 90 years. Now this milestone of course is being celebrated in the presence of the new governor of RBI, that is Mr. Sanjay Malhotra. Right, let's move ahead. Now the name of the governor, etc., these are important with respect to your state PCS, SSC, CGL, banking exams and stuff. In UPSC they don't as such ask you that, but still it doesn't harm for you to remember it. We don't know what UPSC might come up in the coming days. It's also known as Unpredictable Public Service Commission. Right, so let's move ahead. We'll focus on the important points with respect to UPSC examination. Right, so what is this monetary policy? Of course, it's the policy of the central bank's strategy to control the money supply and to facilitate the growth. So control money supply, interest rates in the economy, and to ensure stability and growth. So controlling money supply is done via the interest rates actually. In fact, the growth is also ensured via the interest rates, because it is the interest rates majorly which form the part of monetary policy, in addition to certain reserve requirements as well. So let us see what all are the components of monetary policy. With respect to reserve ratios, we have cash reserve ratio, statutory liquidity ratio, right? With respect to interest rates, you have the bank rate, repo rate, reverse repo rate and marginal standing facility. So these are the major parts, plus one more important thing, that is the open market operation which is there. So let us understand each component one by one. Let's first take all the interest rates that are present in the monetary policy. So the very first is the bank rate. So what is a bank rate? The bank rate is the rate at which the RBI loans its money to the banks for long term. So bank rate, when you talk about, you are talking about long term lending, right? So what is repo rate? Repo rate is the rate at which the RBI give loans to the scheduled commercial bank for short term. So this is for short term. Now, reverse repo is also for short term, but how is it different from repo rate? Reverse repo is the rate of interest that the RBI gives to the scheduled commercial banks when the scheduled commercial banks park their additional money with the RBI. So that is the reverse repo rate. Then what is marginal standing rate, marginal standing funding or marginal standing funding rate? What is it? Sometimes the banks might be in urgent need of money, which will be emergency requirement. So the rate that is charged for such funding, for overnight funding, is known as the marginal standing facility rate, right? So these are the different rates that are present. Now let's understand what are the reserve ratio. RBI regulates the banking system, so it comes up with certain rules, regulations and guidelines under which there are reserve requirements. The RBI comes up with the guidelines so that the banks reserve some amount of money either with itself or with the RBI under different heads, so that in times of need, this amount can act as a buffer, right? So there are two which we'll discuss. One is the cash reserve ratio. It is the amount of money that the scheduled commercial banks are required to keep with the RBI in the form of cash. That is known as cash reserve ratio. Now remember, when additional money is parked with the RBI, the scheduled commercial banks get interest from the RBI. But there is no interest that is provided in the cash reserve ratio. Why? Because this is not the additional money being parked. This is a part of a buffer reserve requirement which they have to keep with the RBI in times for addressing the difficult situations that the bank may face. So no interest is provided by RBI over here. Next is, and it has to be in cash with the RBI. Next is the statutory liquidity ratio. Now this is the amount of money the scheduled commercial banks are required to keep it with themselves in the form of cash, gold or approved securities, or in any of this combination. So statutory liquidity ratio, also known as SLR, is to be kept with the bank themselves, but they can be kept either in completely cash or completely gold or completely approved securities, or any combination of these three things. So these are the major components of monetary policy. But one more remains, that is the open market operation. What is this? See, RBI acts as a bank for the government of India as well. So when the government of India wants to borrow money, the RBI borrows on behalf of the government of India. So government of India borrows by issuing government securities. So the buying and selling of the government securities in the open market is done by the RBI, and it is known as the open market operation. So what is the open market operation of the RBI? It is the buying and selling of the government securities in the open market. That is what the open market operation is. Right. Now, the monetary policies can be majorly of two types. The balance, we are not going to discuss. Balance means the amount of balance. Basically, the RBI tries to balance it by lowering the interest rate or increasing the interest rate, but that is going to bifurcate the monetary policy into two different types. So let us see what are these types. One is the expansionary monetary policy. One is expansionary, the other is contractionary. So what is this expansionary monetary policy? Here the RBI is going to decrease the interest rate. Decrease the interest rate means the repo rate will be decreased over here. They can also decrease the reverse repo. They can decrease both of them. So whatever interest rates that we discussed over here can be decreased. Generally, the repo and the reverse repo are the rates which are more fluctuating in nature, because they are more important to control the inflation or money supply in the market. Why? Because they are for short term. Bank rate may not have that much of influence because it is for long term, as a result of which it is the repo and the reverse repo which are basically fluctuated more. Remember this point. So they will decrease the interest rate, right? They will reduce the reserve requirements, right? And expand open market operation. Now remember, in contractionary policy also you will see the tool of expansion of open market operation, but here there is a different open market operation we are talking about, and here there is a different open market operation we are talking about. Remember, what are open market operation? Buying and selling of the government securities. So here, when it is an expansionary monetary policy, the RBI is going to buy the government securities, and in contractionary it is going to sell the government securities, since both form the part of open market operations, as a result of which open market operations can be done in both the cases, but in one case the RBI is buying and in the other case the RBI is selling. I hope that's clear. Now let us understand how this impacts the market of Indian economy. So let's see and why it is expansionary in nature. Expansionary means, if you are coming up with an expansionary policy, that means you want to provide for growth. You want to increase growth. Inflation is not much of an issue. You want to increase the growth. That means to increase the growth, you need to increase the demand, because when the demand is more, that's when the business will come up to supply for the increased demand. Right? So what do? You either make the money available in the hands of the people, or make the money cheaper so that the people can borrow more and more money. Simple. So that is why you decrease the interest rate. When the interest rate is decreased, let's say the repo rate has decreased, that means the rate at which the RBI gives loan to the scheduled commercial bank has decreased. So the scheduled commercial banks will get loans at cheaper interest rate. When they get the loans at cheaper interest rate, they will give us loans at a cheaper interest rate. So that means more people will be attracted to take loans because the loans are at cheaper rate. That means more money will be in the hands of the people. That means the demand will increase. And when the demand will increase, the supply side, the production side will want to expand and do more activities to provide for this increased demand. As a result of which the economy's growth rate is going to increase. That is why decrease in interest rate. Second, reducing reserve requirements. Why? For example, a bank has 100 rupees to give loan from, but you have a reserve requirement of cash reserve ratio plus statutory liquidity ratio equal to 6 rupees. That means what? If this much amount is reserved, you will have only 94 rupees to give loan from. So less money available to give loan. So less loans can be given. So less money in the hands of the people. So what you will do is you will reduce the reserve requirement. That means from 6 you can do 4. So 100 minus 4, you will have 96 rupees. That means more money to give to the people. So people will have more money in the hand. Hence the demand will increase. Hence the production will increase. Hence the economy can grow. So reduce or decrease the reserve requirements. The third is expand open market operations. But what kind of open market operations? Buying of the government security. Why buying? What is a government security? A government security is a piece of paper, an undertaking, a contract between the government and the person who is buying it, a person who is, let's say, getting those government securities. So let's say the RBI buys the government security, means you guys have the government securities with you, let's say of 10 lakh rupees each. So RBI is buying it back from you. When the RBI is buying it back, so RBI will buy the government security, and against that government security will give you the money that was promised against the government securities. So RBI will get this piece of paper and you will get the money. That means more money in your hands. That means more demand, more production, and faster economic growth rate. I hope that's clear. Now let's move ahead to the contractionary monetary policy. Here basically the inflation might be high, so we want to bring it down, right? So we contract the economy. So how do we do that? So as to reduce the inflation, you want to suck out the money from the economy or make the money costly so that less number of people want to own less amount of money. How do you do that? By increasing the interest rate. When you increase the interest rate, what will happen? When you increase the repo rate, that means the rate at which the RBI is giving loan to the scheduled commercial bank is increased. So less loans, less money will be taken by the banks, and or even if equal amount is taken, it is at a higher interest rate. So the banks would want to give you loans at a higher interest rate, because the interest rate is higher, less number of people will be interested in taking those loans, as a result of which less money in their hands, so less demand, and the production. Less demand means what will happen? Demand is less, so the prices will go down. Then raise the reserve requirement. So from 100 out of 100, 4 was the reserve requirement. So you had 96 rupees to give as loans. Now you can increase it to 6 so that only 94 rupees is there to give as loans. That means less money in the hand of the people. That means less demand, and hence the prices will fall down. Then here you sell the government securities, means you give the piece of the paper. RBI is going to give you the piece of paper, the government security, and take money from you, that is sucking out the money from the economy. So less money in your hands, so less demand, and the inflation goes down. So this is the contractionary monetary policy which may be imposed at times of high inflation to lower the inflation in the economy. So very important concepts, very important. 90 years have been done since RBI first came up with the monetary policy. Let's move ahead with domestically manufactured iron and steel products, that is DMISP policy of 2025. So why this policy? See, India needs a huge amount of infrastructure development. It needs over $10 trillion for infrastructure. Now, 7-8 years back, we were estimating $10 trillion in the next 10 years. Now we need around $10 trillion in the next 6-7 years itself. Huge amount of investment. A lot of it is going to be steel structures. In fact, even in RCC, that is reinforced concrete structures, also you need steel. So steel is required like anything. Now we need to ensure that we get enough of steel so that we don't have to import, or the import at least goes down. As a result of which, and we also want to boost the economy of our own steel industries so that they also do well. Keeping all that in mind, this DMISP policy has come in, wherein the center has unveiled the DMISP policy to curb the rising steel imports and to promote self-reliance, Atmanirbharta. This word is being used by the government every now and then in a lot of context. In the context of pulses also, we are talking about Atmanirbharta. We are talking about in general Atmanirbhar Bharat. So Atmanirbharta, please understand, it means self-reliance. Right? So self-reliance is what we are talking about, to curb the rising steel imports and to promote self-reliance of India. So what is this policy all about? The major point of this policy is that it mandates exclusive use of Indian steel in government procurement. So if there is any government project, it will not import the steel. It is going to use exclusively Indian steel. Right? There is another thing with a reciprocal clause targeting non-reciprocating nations. What is this reciprocal clause? The reciprocal clause is the countries which says that they will have only their country's steel and they will not import. For that country's 100%, we will ensure that we also do not import from them for our government projects. That is one thing. There can be exceptions, but that exception needs to be approved by the government. That is the non-reciprocating nations clause which is present. Now this ministry responsible for this is of course the Ministry of Steel. Let us see the key features. Number one, mandatory Indian steel usage applicable to all PSUs, trust and statutory bodies. That means for all the government bodies, for all the government projects, you are going to use only Indian steel. The steel must meet the melt and pour condition, that is, it is melted in India and solidified in India. That means made in India is what we are talking about. Countries that bar Indian firms from public procurement. So let's say China, for example. China has barred Indian firms for procuring steel for their public project. We will also bar such countries. They will be denied access to Indian government tenders. We will not be giving them Indian government tenders. That's the reciprocal clause. No global tender inquiries for iron and steel products. Right? So no global tenders will be, because you want to consume it first for your Indian requirement itself, so that our import goes down, reduces, and we become self-reliable. Right? Moving ahead, RBI's Remittances Survey 2025. So what is the outcome of this survey? See, the remittances from the Gulf, the Middle East countries was very high. It was more than 50%. Now the trend has changed. So now what has happened, the developed economies, the advanced economies are contributing more towards India's remittances as compared to the Gulf countries. So the Gulf countries percentage from more than 50% has come down to 37%, and the advanced economies has gone to more than 50%. That is the change that has happened. Remember that. So advanced economies now contribute over 50% of India's remittances, surpassing the Gulf with 37.9, that is close to 38%. So Gulf countries from more than 50 has gone down to 37.9. The advanced economies from less than 50 has gone beyond 50%. Now this is reflecting, of course, the changing migrating pattern and economic priorities. Changing migrating pattern, that means the people are more and more migrating to the advanced economies. But remember, that does not mean that the migration is more overall people living in advanced economies more than the Gulf. No, in Gulf still more people are living, Indian people are living, but in the advanced economy, even less number of people are contributing more because the per capita contribution from the advanced economy is higher. Right? That would be on account of higher salary, higher amount being earned by Indians in advanced economy than in Gulf economies. That is what it is talking about. If you look at the share of top 10 inward remittances receiving states in financial year 2024, remember Maharashtra is first, then Kerala. So this can be a very factual question. There is a possibility you think of it as Kerala if you just guess it. In factual questions, avoid guessing. Either you know it or you don't know it. In fact, a lot of such factual questions will be asked when there is sort of a discrepancy. Perception may feel something else, but the reality is something else. Generally, that is the thing on which the factual questions are based. So be very clear when you solve factual questions. Do not simply guess it. Be very sure about it. So Maharashtra is first, then you have Kerala, and then suddenly Tamil Nadu is half of as much as Kerala or Maharashtra. Right? So the third state is at quite low. But if you see, a lot of South Indian states, in fact, after Maharashtra, there are all South Indian states, Kerala, Tamil Nadu, Telangana, Karnataka and Andhra Pradesh. This is a method to remember. This is not discriminating that they are doing well and someone other states are not. That is the reality. However, this is also a way for you to remember that Maharashtra is top. After that, these are all the South Indian states that we are talking about. With respect to the top 10 originators of inward remittances, USA is topping with 27.7, and then you have UAE, and then another advanced economy, UK, and then comes the another Middle East. So advanced economy, Middle East, advanced economy, Middle East. Advanced economy, Gulf country, advanced economy, Gulf country, USA is the topmost. This change has happened, so it becomes very important. Moving ahead, National Bank for Financing Infrastructure and Development, NABFID. So now this particular National Bank for Financing Infrastructure and Development and the New Development Bank, they have signed a strategic MOU together. So this bank, NABFID, has signed a strategic MOU with the New Development Bank for what? To boost the cooperation in long-term infrastructure and clean financing, right? To boost the let's say investment in the infrastructure and clean financing. So not just infrastructure but clean financing, clean infrastructure is what we are talking about here. So what is NABFID? It is basically a development finance institution that is dedicated for long-term infrastructure projects. See, infrastructure requires funding for a long duration. The gestation period is longer, so that is why it becomes difficult for infrastructure projects to find funding. So this is an a specific financing institute for long-term infrastructure project. It was established under NABFID Act 2021. It is regulated by, of course, the RBI as an all India financial institution, AIFI. Moving ahead, it has signed an MOU with NDB, that is New Development Bank. So what is that? New Development Bank is a bank formed by the BRICS nation, the idea of which was proposed in 2012 BRICS summit in New Delhi, and it got established by the Fortaleza Declaration. In 2014, this declaration came in and the bank became functional from 2015. Moving ahead, the credit flows in MSME. Now, there is a huge amount of credit gap in the MSME. If you estimate around $330 billion of gap which is there, prompting a growing shift towards decentralized digital crediting system. That means you have to provide more amount of decentralized finances so that credit becomes available to the MSME sector, because there is a huge gap in the credit financing of MSME. So let us see what all the government is doing. Number one, priority sector lending mandate. MSME is one of the priority sector, right? That means, see, priority sector lending is what the banks are obliged to give certain percentage of loan only to priority sector. So MSME is one of the priority sector, hence it will ensure that they get loans easily. However, there are various other priority sectors also. So what may happen that the banks may give to some other priority sector and not this. So it may impact but not completely. That is why other things are also there. Next is credit guarantee fund trust for micro and small enterprises. What is credit guarantee? Basically giving collateral free loans. In this year's budget also the government has talked about collateral free loans up to 500 lakh with up to 85% guarantee coverage for MSME under the credit guarantee scheme. So these loans will be collateral free. Then you have the Prime Minister's Employment Generation Program, which offers monetary money subsidy on loans up to 50 lakh for manufacturing and 20 lakhs for services to boost self-employment and entrepreneurship. So this is to facilitate people to start more and more MSMEs for self-employment, and it is also going to generate huge amount of jobs, right? Moving ahead, Udyam registration portal and Udyam assistant platforms. What is this? This basically is a free online platform that facilitates registration and formalization of MSMEs, right? So MSMEs are there, many of them will be in the unorganized sector, they are not registered. So this helps in facilitating the registration and hence the formalization of MSMEs. When the MSMEs are formalized, it becomes easier for them to take loans from the institutions rather than non-institutional sources. Then you have 5 PM Vishwakarma Yojana, launched in 23. It provides for subsidized loans, skill training and toolkit support to artisans in 18 traditional trades to integrate them into the credit system. Now the important point is the 18 traditional trades. So when you talk about MSME, still Indian MSME are not that technologically advanced, but a lot of MSMEs are talking about use of machinery. So the equipment is developed with the help of machinery, but India has a lot of traditional craftspersons and a lot of traditional trades and artisans who are there. So to support them specifically, the 5 PM Vishwakarma Yojana is brought in the MSME sector. Hope that's clear. Let's move ahead to the non-tariff barriers. Now why is this in news? Because of the visit of Vice President of USA, who urged India to eliminate the non-tariff barriers. So what are the tariff and non-tariff barriers? See, tariff barriers are basically the custom duties, countervailing duties, import duties which are imposed on the imports that are coming from other nations to India. So let's say USA is exporting its goods to India, we will impose an import duty. Why? For example, on the vehicle brand Harley Davidson, let's say we have an import duty of 100%. That means what? The vehicle might be of 3 lakh rupees, but we impose 100% import duty, so it will become of 6 lakh rupees, which will make it costly. One, it generates revenue for the government. Second, it is costlier, so that now the Indians would focus on buying more of Indian manufactured bikes rather than Harley Davidson coming from abroad. So it is a way to protect our own industry, right? Until and unless we also become technologically advanced to compete with them. So these are the reasons why we do that. Now that is basically a tariff barrier. You are simply imposing a tariff, a tax, right, which is monetary in nature. So this is tariff barrier. Now there can be certain non-tariff barriers as well. What is non-tariff barriers? For example, sanitary, phytosanitary reasons. We may find, sometimes the countries simply ban the exports of other countries into their own country because of sanitary, phytosanitary reasons, because of environmental reasons, because of, let's say, human rights violation reasons, saying that, for example, if we might be getting something from Vietnam, some textile product from Vietnam, we can simply ban it by saying that the people who are producing this are not being given the basic human rights. For example, in Vietnam and Bangladesh, there are sweatshops. Now, what is the sweatshops? In this shops, textiles, a lot of sports products like the footballs from Nike, Adidas, the shoes, etc. are woven, are being manufactured in a small room where 50 plus people sit without proper ventilation, proper ambience, proper environment, in a very pathetic situation and condition, with very low amount of income, such low that even the basic human rights are not met, even the basic requirements of food, clothing, shelter is not addressed with the amount of the payments they get. And these brands sell the products at a very costly price. Why? Because they make huge profits, that one, and they rather pay very high to the sponsors, to the brand ambassadors, and that's where their money goes and not to these poor people. So India can simply say this is inhumane treatment of the workers in your countries. So this is a non-tariff barrier that India can impose, or India can also limit the amount of imports that India gets from these countries for a specific product. So that will be non-tariff barrier. You're not increasing the tariff or imposing any tariff to make it costly so that the demand may go down. You yourself are rejecting or giving a limit of the amount of imports that you are ready to have. These are your non-tariff barriers. Trade restrictions other than custom duties are the non-tariff barriers which sort of hinder the free flow of goods. Right? So these are your non-tariff barriers. They can be technical, example certification, technical barriers. You are sending this product, we want to ensure that it is certified by some institution, by our own institution or a world organization institution, so as to ensure the quality, the safety regulations, so on and so forth. So this is a non-tariff barrier. Non-technical, example quotas, limitations, sanitary, phytosanitary, environment, human rights violation, etc. All these reasons can be non-tariff reasons. Now here any country will come up with any standard and can easily reject it. That is why this leads to hindrance in the free trade which is being talked about. Next is the World Bank's poverty and equity brief. It has complimented or sort of praised the Indian effort to eliminate or to reduce poverty. It is said that around 171 million people, that means over 17 crore people, were left out of poverty in the last around decade. So from 2011-12 to 22-23, over 171 million people were removed or lifted out of poverty by India during this period. Now about this report, it is published twice a year. That means every 6 months this is published. They track the poverty, the shared prosperity and the inequality trend in over 100 developing countries. Moving ahead, what is the highlight? Extreme poverty. Extreme poverty means living under $2.15 per day. This is the definition of extreme poverty as per World Bank. So if you talk about it, it has declined from 16.2% to 2.3%. Extreme poverty, not the overall poverty. Extreme poverty has declined to this. Lower middle income, here the poverty that is living under $3.65 per day, it has fell from 61.8% to 28.1%. Moving ahead, the multidimensional poverty, it has declined from around close to 54 to 15.5% in around 1.5 decade. Now inequality reduction, the Gini coefficient has also improved from 28.8 to 25.5. Remember, the higher the Gini coefficient, the higher is the inequality. Lower the Gini coefficient, lower is the inequality. So Gini coefficient has reduced, hence the inequality has reduced. And finally, the employment growth. Urban unemployment dropped to 6.6%, the lowest since 2017-18. So this is the positive that we are talking about. If we talk about the multidimensional poverty index, it has the following factors: health, education and standard of living. It is from 1 out of 1, from 0 to 1, right? And there are 3 dimensions. Each dimension is given a weightage of 1/3. Health has 3 dimensions: nutrition, child and adolescent mortality, maternal health. Education has years of schooling and school attendance. Then you have standard of living. Standard of living has 2, 4, 6 and 7. Since it has 7, so each of the component will be having 1/21 of the weightage. So there is cooking coal, cooking fuel, sanitation, drinking water, housing, electricity, assets and bank account. Now if you see, these are marked sort of yellow orangish. These are newly added. Presently it had only 2, so this would have been 1 by 6, 1 by 6, but now the third one is added. First one remains 1 by 6 weightage. This is 1/12 and 1/12 maternal health is recently added. Bank account here is recently added. Previously there were only 6, so the weightage individually here was 118. Now it has changed to 121 because the 7th one has been added over here. This is your multi-dimensional poverty index. So India in the last decade and a half has done well with respect to reducing poverty, multi-dimensional poverty, also reducing inequality as well. So this was, guys, all about your April 2025 current affairs. I hope you have understood this. I hope you remember the facts that we have taken. So wish you all the best for your upcoming prelims examination. Thank you.